Exercise 5.4a is a review of the adjustment for depreciation. Before we begin that exercise, let's review how to calculate depreciation. Remember that there are two steps in calculating depreciation. The first step is to determine the depreciable cost. How much of the cost of that asset can we depreciate? And depreciable cost is determined by subtracting salvage value from the original cost. So the original cost minus salvage value equals depreciable cost. That is the amount that we can depreciate. So then the second step, we will determine the amount of depreciation by taking that depreciable cost and dividing by the useful life. Remember, the useful life is how long we're going to be able to use this equipment in our business. I'll remind you the definition of salvage value is the amount that we think we could sell the item for at the end of that useful life. So these are the two steps in calculating depreciation. You must first calculate depreciable cost, original cost minus salvage value. Once you have that depreciable cost, you divide by useful life to get the depreciation. Okay, so let's look at exercise 5.4a. Okay, 5.4a says on December 1st, delivery equipment was purchased for $7,200. That's your original cost. The delivery equipment has an estimated useful life of 4 years or 48 months and no salvage value. No salvage value means that they do not believe that they will be able to sell this equipment for anything at the end of the useful life. So using straight line depreciation, analyze the necessary adjusting entry as of December 31st, 1 month. We will have owned this item for 1 month. So we are to analyze it using T accounts and then formally enter this adjustment in the general journal. So before we can make the adjusting entry for depreciation, we must calculate depreciation. So just like we just discussed, step 1 is going to be to determine the depreciable cost. And depreciable cost is going to be the original cost minus the salvage value. So our original cost in this problem was $7,200. They said that there is no salvage value, so 7,200 minus 0 tells us that our depreciable cost, the amount we can depreciate, is $7,200. Step 2, to calculate depreciation, the actual amount of depreciation, we're going to divide that depreciable cost by the useful life. So our depreciable cost, $7,200, divided by the useful life. Okay, the useful life was 4 years or 48 months. So which do we need to use to calculate depreciation? Well, it depends. If we were calculating depreciation for a year, then we would divide by 4 to get the amount of depreciation per year. However, we've only owned this asset for 1 month, December 1st through December 31st. So we need to calculate the amount of depreciation for that 1 month. So it makes more sense to divide by 48 months, and that would give us our depreciation per month of $150. $150 depreciation per month. Okay, the adjusting entry for depreciation is always a debit to depreciation expense and a credit to accumulated depreciation for the amount of depreciation for the period. So we are going to debit depreciation expense for $150, and we are going to credit accumulated depreciation for $150. Remember, in the adjustment for depreciation, you never make an entry to the actual asset account itself. So in this case, the delivery equipment. You're not going to make an entry to that account. We use the contra asset account, accumulated depreciation. Accumulated depreciation is the opposite. Contra means opposite. So the contra asset account, accumulated depreciation, is the opposite of the asset account it's related to. So delivery equipment will have a debit balance. Accumulated depreciation is going to have a credit balance. Okay, once you've used the T accounts to analyze, then of course we have to enter the adjustment in the journal. So you're going to write adjusting entries on the first line. The date of our adjustment, last day of the period. So for this problem, it is December 31st. We are going to debit, and I'm going to have to abbreviate here because I can't write small enough with this computer. So we're going to debit depreciation expense, delivery equipment for $150, and we are going to credit accumulated depreciation, delivery equipment for $150. Okay, so our debits equal our credits. So this is what your adjusting entry for depreciation should look like.